Hey everyone, welcome back for our deep dive. And this time, we're tackling index funds. You guys know, the ones everyone and their grandma seems to be raving about these days. You flooded my inbox after that Margin World episode, so we're diving into that transcript today.
It's everywhere you look, right?
Seriously, it's like the latest buzzword, but is it really all it's cracked up to be? I'll admit I'm a little lost.
Haha. Well, that's what we're here to unpack. And a healthy dose of skepticism is never a bad thing when it comes to investing.
Right, so where do we even start? The Margin World episode had a lot to say.
For sure. They did a good job of laying out the basics, though, even for someone who's never even thought about investing before.
Okay, good, because sometimes I feel like I need a dictionary just to understand what these financial gurus are talking about.
The jargon can be a bit much.
So, from what I gathered, it's like buying these teeny tiny pieces of giant companies. I think they use the S&P 500 as an example.
Exactly. Like, imagine owning a tiny sliver of every company listed on the S&P 500.
Instead of like picking individual stocks and hoping for the best.
Exactly. It's more about riding the overall market wave rather than trying to pick and choose winners and losers.
Sounds almost too easy. Like, just ride the wave and make money. What's the catch?
Yeah.
There's always a catch, right?
Well, there are no guarantees in investing, but index funds do offer some pretty compelling advantages. One of the biggest being those low fees you always hear about.
Okay, but aren't all fees kinda, well, boring?
They sound boring, but trust me on this one. Margin World gave this example that really stuck with me. Imagine you invest $10,000 and get an average return of 7% each year. Seems pretty good, right?
Yeah, not bad.
But here's the thing. Over 30 years, a tiny 1% difference in fees could mean you end up with tens of thousands of dollars less. It's the magic of compounding.
Okay, you've definitely got my attention now.
Oh.
I never really thought about fees like that.
Yeah.
So low fees, big impact over time.
Mm-hmm.
What else makes these index funds so special?
Well, another huge plus is the diversification they offer. Instead of putting all your eggs in one basket, hoping that one company takes off, you're spreading your investment across hundreds, sometimes even thousands of companies.
Okay, that makes sense. Less risk, right?
Exactly. And you don't have to spend hours researching every single company yourself, trying to pick the winners. The index fund kind of does it for you.
See, now that part I like. Because honestly, researching companies, that's like a whole other job. And, speaking of things I'm not so great at, the Margin World folks talked about emotions and investing and how it can mess you up, the whole emotional roller coaster thing. And I got to admit, that hit home because I tend to panic whenever the market dips, even a little.
Oh, tell me about it. We've all been there. It's so easy to get caught up in those short-term fluctuations.
Right. Like suddenly I'm questioning every financial decision I've ever made.
And that's exactly what Margin World was getting at. When you're constantly reacting to every little market swing, you're way more likely to make impulsive decisions that could hurt you in the long run.
Like buying high out of fear, then selling low out of panic. Ouch.
Exactly. And that's where index funds can be helpful because they encourage you to think long term.
Okay, slow and steady wins the race.
Oh, yeah.
Got it. But do these index funds actually perform well? Can they really outperform those fancy actively managed funds with all their analysts and algorithms? Those always sounded so intimidating.
Well, that's the million-dollar question, right? Do those expensive fund managers actually deliver? And honestly, what Margin World dug up might surprise you.
Okay, you've got my attention. Lay it on me.
So they cited this research that found that something like 90% of actively managed funds actually underperformed compared to just following the index. And get this was over a 15-year period they were looking at.
Whoa, 90%. That's like the majority, not even close.
It is pretty wild, right? Kind of makes you wonder about all those fees, huh?
Seriously. Like, you'd think with all their fancy algorithms and teams of analysts, they'd be able to beat the market, right?
You'd think. But this really highlights why index funds are so compelling. It's not about trying to outsmart everyone else. It's more about that slow and steady approach. Just riding the wave of the overall market growth, which historically has trended upwards over the long term.
Okay, you're really making me rethink my whole investing strategy here. So let's say I'm ready to jump on this index fund bandwagon. The Margin World episode made it sound pretty simple to get started, even if you're not exactly rolling in dough. Is that true?
Yeah, they were spot on about that. That's one of the best things about index funds. You don't need a fortune to get started.
Music to my ears.
They mentioned a few popular options like Vanguard, Fidelity, and Charles Schwab, at least for those of us in the U.S. But there are similar platforms, internationally as well.
That's good to know. But what about those minimum investment amounts you always hear about? Those can be pretty intimidating.
Right, but that's where those fractional shares come in.
Fractional shares.
Yeah, they talked about it briefly on the show. It's basically like buying a portion of a share so you can invest with, like, even $50 or $100. Doesn't have to be this huge amount to get started.
Wow, that's really cool. Okay, see, this is why I wanted to do this deep dive.
Yeah.
Okay, another thing that caught my ear was them talking about the tax advantages. Because who doesn't want to keep more of their hard-earned money,
Yeah.
right?
Tax is everyone's favorite topic, but it is important.
So break it down for me. How are index funds better for taxes?
It comes down to something called the turnover rate.
Turnover rate. Okay, more jargon?
Sorry. Basically, because index funds are tracking an index, they're not buying and selling individual stocks all the time, like those actively managed funds. So they have a lower turnover rate, which usually means fewer taxable events, especially over, you guessed it, the long term.
Right, long-term seems to be the theme here.
Got it. But are there different kinds of index funds? I mean, Margin World seemed pretty focused on the S&P 500.
Oh yeah, they barely scratched the surface there. There's a whole universe of index funds out there.
Oh, yeah. Like, you can find index funds that focus on international markets, bonds, even specific sectors if you're feeling adventurous.
Okay, now that sounds way more interesting than I thought index funds could be.
There's something for everyone, right?
So how do you choose? Like, how do you know which index fund is right for you?
Well, that's where it's important to consider your own personal situation, right? What are your goals? How much risk are you comfortable with? Margin World really emphasized that aligning your investments with your time frame and your risk tolerance.
That makes sense. Like, if I'm investing for retirement, that's way different than, say, saving for a down payment on a house, right?
Huge difference. One's a marathon, the other is more like a sprint.
Right, okay, so it's not all rainbows and unicorns with index funds, right? It's got to be some downsides. Didn't the Margin World episode mention some risks too?
Oh, absolutely. It's not all smooth sailing. Remember that whole 2008 financial crisis they talked about?
Yeah, that part was a little scary. Like, even those diversified index funds weren't immune when the whole market went haywire.
Right, exactly. It's a good reminder that every investment comes with some level of risk.
So even with index funds, there's no such thing as a sure thing.
Unfortunately not. When the market takes a downturn, your index fund is probably going to reflect that. But remember what Margin World said. Historically, the market has always bounced back.
Okay, so it's about riding out those rough patches, not trying to dodge them altogether.
Yep. It's a long game, remember? And speaking of things that aren't always perfect, remember how Margin World mentioned that limited customization thing with index funds?
Right, you're kind of stuck with whatever's in that preset basket of companies. You don't get to pick and choose individual stocks like you might with a fancier, actively managed fund.
Exactly. So it's about deciding what's more important to you. Do you want that simplicity and those lower fees, or do you want more control over every single stock pick? There's a trade-off there.
Makes sense. Okay, so to wrap things up, it sounds like index funds are a pretty solid option, especially if you're playing the long game. They're low cost, diversified, and you don't need a ton of cash to get started. But like any investment, you got to do your research, figure out your risk tolerance, and be prepared for those market ups and downs.
Couldn't have said it better myself. And hey, remember that thought-provoking question Margin World left us with? If all those high-priced experts with their actively managed funds often can't even beat the market, makes you wonder where the real value of financial expertise lies, doesn't it?
That's a really good point.
Yeah.
Maybe those hefty fees aren't always worth it after all.
Something to think about.
Well, thanks for taking this deep dive with me. I feel like I learned a ton.
Me too. It's always fun to geek out about this stuff.
And to everyone listening, thanks for joining us. This is just the beginning of your index fund journey, right? Keep learning, keep asking those smart questions, and most importantly, keep investing in your future. We'll catch you next time.